It starts with a simple fear: what if the market tanks just as you're relying on your savings? That fear has a name: sequence of returns risk, and it's driving more retirees than ever to park their 401k in cash. Picture this. You retire, your portfolio sits at $500,000, and you withdraw $25,000 in year one to cover living expenses. If the market drops 20% that first year, you're down to $375,000, and now that same $25,000 withdrawal represents a much larger percentage of your remaining balance. To get back to even, you don't just need a 20% gain, you need 33%. Suddenly, recovery feels like climbing a steeper hill. Even if stocks bounce back over time, those early losses carve deep gouges in your nest egg, and the longer it takes to recoup, the more withdrawals you have to make along the way. That's why so many retirees decide the slow erosion of cash in a high-yield account is preferable to the roller coaster ride of equities. Cash can't lose 20% in a month. It can't subject you to gut-wrenching paper losses just when you need your money most. You trade potential upside for absolute certainty. Your balance might grow slowly, but it will never drop overnight. Emotionally, that peace of mind is huge. Knowing your bills are covered, knowing you can sleep through a market crash, knowing you won't have to second-guess whether you're pulling out too much or too soon. It feels safer, even if it means surrendering the higher long-term returns that stocks historically deliver. But when the fear of an early drop looms larger than the hope of future gains, cash becomes the harbor retirees choose: steady, predictable, and free of sequence of returns anxiety. Forget the days when cash paid barely enough interest to cover a stamp. Today, high-yield savings accounts and money market funds are dishing out 4% or more, rates you haven't seen since before the Great Recession. For retirees who remember 0% returns on their savings, this feels like stumbling onto a secret fountain of risk-free income. Instead of locking money into stocks or bonds and praying for market growth, they're opting for the comfort of a guaranteed yield that stacks up against inflation, at least in the short term. What's driving this shift is the Federal Reserve's aggressive rate hikes over the last few years. As benchmark rates climbed, banks followed suit, raising their deposit rates to attract cash. Suddenly, the nothing return on your checking account looks like an opportunity. Retirees who've watched their bond funds tumble or seen stock portfolios swing wildly know that a locked-in 4% on cash, no matter how modest, beats the uncertainty of dividends and capital gains. It lets them plan their income streams down to the penny without worrying that a Fed pivot or credit market disruption will erase their next paycheck. And it's not just big national banks offering these rates. Online platforms, credit unions, and fintech firms are competing fiercely for deposits, meaning retirees can shop around for the highest rate without jumping through hoops. Some are even adding sign-up bonuses or tiered yields for larger balances, effectively turning cash into a quasi-investment. For someone living on a fixed budget, scrubbing out the roller coaster risk becomes more important than chasing an extra percentage point of return in the equities market. Of course, there's a catch. These rates can fall if the Fed reverses course. But for now, the headline number looks unbeatable compared to bond yields or dividend payouts. And when every dollar counts, locking in a known return, even if it's just cash, feels like leveraging a rare market inefficiency. That's why retirees who once scoffed at parking money now see it as a tactical play. Harvest guaranteed income today, then decide later whether to tiptoe back into riskier assets once rates or their own comfort level change. Many retirees don't realize how much of their portfolio gets quietly siphoned off by hidden fees and account minimum penalties. Think about it. Every trade you place, every fund you pick, every small balance you leave untouched can trigger charges that slowly erode your returns. Brokerages tack on commissions, custodians levy annual administrative fees, and mutual funds embed expense ratios that are deducted daily, often without any line item showing up on your statement. Over a decade, those 0.5% or 1% fees can wipe out tens of thousands of dollars you thought was safely invested. Then there are account minimums. Some custodians charge you if your balance dips below a threshold, sometimes as high as $100,000, or convert your account into a fee-based model automatically. Retirees who fear market dips may leave assets in mutual funds to avoid selling during downturns, but that can leave them subject to higher minimum fees or premium share class expense ratios. And don't forget platform fees for access to certain investments, such as real estate or alternative assets, which can add an extra layer of cost beyond the visible fund expense ratio. The cash alternative sidesteps these traps. Money market accounts, high-yield savings, and CDs typically come with zero commissions, no expense ratios, and no minimum balance penalties, especially at online banks or credit unions. You know exactly what you're getting. The published annual percentage yield, paid monthly or quarterly with no hidden deductions. When every basis point counts, that transparency has a powerful appeal. More retirees are waking up to the fact that fees matter as much as performance. A stock that returns 8% but carries a 1.2% fee actually nets you just 6.8%. A bond fund with a 0.9% expense ratio cuts into already low yields. In contrast, locking cash at a 4% yield with no fees feels like an unbeatable net return. For many, the predictability, knowing that no mysterious line item charges will arrive next April, outweighs the pull of potentially higher but less certain market gains. And as they compare statements side by side, the fee-free simplicity of cash often wins out, reinforcing the trend of moving 401k balances into liquid, zero-fee vehicles. Retirees aren't just chasing yields, they're chasing certainty, the kind of guarantee that lets them budget down to the last dollar. In a market where dividends can be cut, bond coupons can dry up, and principal values can swing wildly, cash offers an unbreakable promise. You will get exactly what it says on the tin. That means when you set up a cash bucket, you know your income for, say, the next 3 to 5 years is locked in. No surprises. No sequence of returns nightmares. Just steady, unwavering payments you can rely on to cover rent, groceries, medications, and insurance premiums. This liquid paycheck approach carries enormous psychological weight. Imagine waking up on Monday morning and knowing your entire month's bills are already funded, without needing to check the market or wait for dividends. That peace of mind can be worth more than an extra percentage point of return that might vanish in a market swoon. Retirees tell us they sleep better, feel less stressed, and find it easier to stick to a spending plan when they can see their dedicated cash buckets set aside like a safety net. Setting it up can be as simple as carving out a portion of your 401k, enough to cover your fixed expenses for 2 or 3 years, and placing it into a laddered series of CDs or a money market account with predictable maturities. Meanwhile, the remainder stays invested for long-term growth. When cash expires in a ladder, you refill it using assets from your growth bucket, taking advantage of potential market recoveries before locking in new safe funds. Of course, there's a trade-off. Cash won't keep up with inflation over decades. But by rotating between cash and growth, moving only what you need each year, retirees strike a balance between preserving purchasing power and ensuring immediate expenses are fully covered. In a world of uncertainty, that clarity and control explain why retirees are embracing cash not as a bank account, but as a cornerstone of their retirement income strategy, trading a bit of upside for a lot of confidence. Cash might feel like a fortress against market swings, but there's a hidden risk eating away at your nest egg every day. Inflation. When prices climb faster than the interest you're earning, your cash bucket quietly shrinks in real terms, even as the nominal balance ticks upward. Picture this. You lock in a 4% yield on a high-yield account, pat yourself on the back, only to discover that grocery prices are climbing at 6% a year, healthcare costs by 5%, and utility bills by another 4%. Suddenly, that seemingly safe income buys less and less. The real danger isn't an abrupt crash, it's the slow bleed. $1 today might cover your prescription refill, but in 5 years, you'll need more than $1.25 to get the same medicine. And while equities or bonds can offer dividends or coupons that theoretically keep pace or even outpace inflation, cash cannot. It's anchored to the published interest rate, which often lags behind the real cost of living. That discrepancy might look small in a single year, but over a decade it compounds into a dramatic loss of purchasing power. Retirees who shift large portions of their 401k into cash often underestimate just how fast their expenses can outpace those safe yields. They feel secure, no headline-grabbing losses, but they don't realize that safe today can mean insufficient tomorrow, especially with essential costs like medical premiums, property taxes, and groceries rising unpredictably. Relying too heavily on cash can turn your moat into quicksand. And here's the kicker. It's nearly impossible to spot in your statements. You see your balance growing, but unless you compare it to the basket of goods you actually buy, you won't notice the erosion until it's painful. That's why savvy retirees carve out only a short-term chunk for cash, enough to buy certainty for a handful of years, while keeping the rest invested in assets that at least aim to outrun inflation. But understanding inflation's stealthy erosion is only half the battle. Up next, we'll dig into the behavioral biases and herd mentality that convince retirees to abandon growth entirely, even when that choice could cost them far more in the long run. Fear is contagious. When one retiree moves a big chunk of their 401k into cash, it sends ripples through their social circle, their neighborhood, even their online forums. Soon, dozens more are doing the same, not because they ran the numbers, but because they saw someone else do it. This herd mentality taps into powerful behavioral biases, loss aversion, where the pain of a market drop overwhelms the joy of potential gains, social proof, where we assume the group must know something we don't, and status quo bias, making us stick with whatever everyone else is doing. Imagine Mrs. Thompson down the block who posted on the retiree's social page, "I just moved everything to cash, sleeping better than ever." Next thing you know, her friend Jerry, who was fully invested, wakes up in a cold sweat after a bad dream about a market crash. Without rechecking his own plan, he follows suit. Then his neighbor Pam calls her advisor in a panic, only to be told she can't afford to miss out on safety. Within days, a domino effect sweeps through the community. No one stops to ask, what are my expenses in 5 years? Am I actually earning more in cash than the portfolio could deliver? They just see, look at me safety, and they sprint after it. Financial advisors often find themselves fighting an uphill battle against this momentum. They can show charts, run Monte Carlo simulations, even explain inflation risk, and still, retirees cling to the group move. It's easier to follow than to think, especially when emotions are high and headlines scream uncertainty. This collective jump to cash isn't rooted in logic. It's rooted in our brains looking for quick relief from fear. Yet if you pause and examine the facts, you'll see that a blanket shift to cash overlooks individual goals, timelines, and risk tolerances. Recognizing the herd instinct is the first step toward resisting it. And once you break free from the crowd's fear, you can explore hybrid models that blend security with growth, so you're not left chasing the next panicked wave, but riding the one that actually serves your long-term needs. What if you could have the best of both worlds? Enough cash to cover your short-term needs, and enough growth potential to outpace inflation. That's exactly why a growing number of retirees are adopting hybrid cash and growth strategies, rather than parking everything in a single bucket. At the heart of this approach is the multi-bucket system. You divide your portfolio into a cash bucket for immediate expenses, say 2 to 3 years worth, alongside a growth bucket invested in equities, dividend ETFs, or bond ladders designed to generate higher inflation-beating returns over the long haul. When your cash bucket starts to deplete, you refill it with a withdrawal from the growth bucket. If markets are up, you're effectively locking in gains. If markets are down, you wait for a rebound before topping up. This guardrail technique smooths out sequence of returns risk while ensuring you never sell into a crash. Some retirees take it further by adding a dynamic glide path, adjusting the size of their cash cushion based on market conditions. For instance, if the S&P 500 hits new highs, they might sell a bit more into cash, harvesting profits when valuations are frothy. Conversely, when markets dip 10% or more, they hold off on reloading cash buckets and allow the growth bucket to recover. It's a disciplined, rules-based process that injects flexibility into a retirement plan without the emotional whiplash of check balance, gasp, sell everything. Another layer involves dividend-focused ETFs or short-term bond ladders in the growth bucket. These provide modest income and lower volatility compared to pure stocks, yet still offer a better chance of keeping pace with inflation than cash alone. By contrast, cash yields, even at today's elevated rates, often trail behind real living cost increases over the long term. Finally, some retirees blend in a small allocation to alternative income sources like covered call funds or real estate investment trusts that can pay out monthly distributions while capping downside. Allocations here are small, so they won't derail the conservative nature of the plan, but they can boost income and diversify risk. The beauty of this hybrid model is that it's tailored based on your spending needs, your market outlook, and your risk tolerance. It acknowledges that no single asset class has all the answers. You get the psychological comfort of knowing bills are covered and the financial resilience of staying invested for growth. In 2025, as interest rates, inflation, and markets continue to surprise, this balanced, adaptive framework could be the smartest way to leverage cash without surrendering your future. As you've seen, the rush to cash isn't just a knee-jerk reaction to market headlines. It's a complex dance between fear, opportunity, and the quest for certainty in an uncertain world. But parking your entire 401k in cash carries its own perils. Inflation's silent erosion, lost growth potential, and the vulnerability to outliving your money if rates fall again. That's why the smartest retirees aren't choosing extremes. They're crafting hybrid plans that balance immediate safety with long-term resilience. The key takeaway? Cash is a tool, not a destination. Use it to shield yourself from sequence of returns risk, lock in short-term income, and sleep better at night. But don't let it become a trap that leaves your savings stranded below the inflation line. Sequence of returns anxiety will never vanish entirely, but structuring your cash buckets, guardrails, and growth allocations can tame it. And while high yields on cash accounts are a welcome shift, remember that today's rates may not last forever. Behavioral biases will always tug at your emotions. Herd mentality can feel like safety in numbers until the crowd turns on you. Recognize those impulses and build strategies that give you confidence without isolating you from market upside. A multi-bucket system, dynamic glide path, and diversified income streams combine to offer both protection and progress, adapting to changing conditions while keeping your goals front and center. So, before you move all your 401k to cash, pause and reflect. What are your time frame, your essential expenses, and your tolerance for volatility? How will inflation affect your cost of living 5, 10, or 15 years from now? And what plan will you follow when rates or markets shift again? The answer isn't found in a single account balance or a fleeting headline. It's in a personalized framework that blends liquidity, yield, and growth. Retirement is a marathon, not a sprint. Cash can be the safety net that prevents a stumble, but growth is the engine that carries you forward. In 2025 and beyond, the best results won't come from choosing one side exclusively. They'll come from knowing when and how to shift between them. Because true financial peace isn't about avoiding every risk, it's about managing the right ones to secure the future you deserve.